92% of blown trading accounts have one thing in common. It's not a bad strategy. It's not the market makers, the algos, or the news. It's position size. Specifically, it's a position size that was too big to survive being wrong. Here's the claim that's going to make some of you angry. Trading small makes more money than trading big. Not sometimes. Not in certain conditions. Almost always. Over any meaningful stretch of time, the trader risking less per trade ends up with more money than the trader risking more. That sounds backwards. It sounds like something a coward would tell himself to feel better about being timid. It isn't. It's math. And today, I'm going to show you exactly why the smallest position sizes in the room usually belong to the biggest accounts in the room. You already know what it feels like to size up. You find a setup that looks perfect, the chart is clean, the story makes sense, your confidence is at 10 out of 10. So you think, why risk 1% on this? Why not risk 5? Why not risk everything I've got? Because this one is different. This one you know. And you've probably also lived the other side of that feeling. The trade goes against you, fast. And because the size was big, the loss isn't just a loss, it's a gut punch. It's the kind of red number that makes your hands shake a little when you look at the account balance. You close the platform, you tell yourself you'll trade smaller next time. Then, 2 weeks later, another perfect setup shows up, and the cycle starts again. You're not stupid, you're not undisciplined in the way you think you are. You've read the books, you know what a stop loss is, you can probably explain risk-reward ratios better than most finance graduates. And you still keep ending up here, staring at an account that's smaller than it was 6 months ago. So what's actually going on? It's not your strategy, it's not your indicators, it's not your broker, your platform, or your internet connection. The difference between the trader who blows up and the trader who compounds for a decade has almost nothing to do with how they find trades. It has everything to do with how much they bet on each one. The real villain here isn't ignorance. It's most traders have never actually sat down and done the math on what a large loss does to an account and what a small, repeatable edge does over hundreds of trades. Once you see that math, you can't unsee it. Let me introduce you to two traders. Call them Marcus and Sarah. Marcus is an engineer, sharp, analytical, the kind of guy who builds spreadsheets for fun. He started trading with $50,000, and within his first year, he had the whole thing mapped out. He backtested his strategy over a decade of data. He knew his win rate down to the decimal point. He was, by every measure of intelligence, more qualified to trade than almost anyone else in his friend group. Marcus's problem was conviction. When his system flagged a high-confidence setup, he didn't risk 1% of his account. He risked 8, sometimes 12. Why wouldn't he? He'd done the backtest. He knew this pattern worked 70% of the time. In his mind, sizing small on a 70% setup was leaving money on the table. For 4 months, it worked beautifully. His account went from $50,000 to $81,000. He started telling people at work about it, casually, the way you mention a good restaurant. Then came a Tuesday in March, a geopolitical headline nobody priced in. His highest conviction setup of the quarter, sized at 14% of his account, gapped against him overnight. No warning, no chance to adjust. He woke up down $19,000 before the market even fully opened. Here's the part that matters. Marcus's strategy was still correct. His edge was still real. But one trade, one moment of maximum conviction sized at maximum aggression, erased 5 months of careful, accurate analysis. He didn't just lose money, he lost the emotional stability to execute his own system. 2 months later, chasing the loss, sizing even bigger to get it back faster, he blew through what was left. $61,000 gone, and the strategy was never the problem. Now, Sarah. Sarah drives a school bus. She started trading with $11,000, money she'd saved over 3 years. And she had exactly one rule that she refused to break under any circumstance. Never risk more than 1% of the account on a single trade. Not 1.5. Not just this once. 1%. Every time, Sarah's strategy wasn't complicated. It wasn't even particularly clever. Some of her setups were honestly mediocre compared to what Marcus was running. But because she never risked more than 1%, a losing streak that would have destroyed Marcus's account barely registered on hers. She had an 11-trade losing streak in her second year. 11 losses in a row. Her account dropped by roughly 10%. She didn't panic because 10% was survivable. She kept executing the same 1% rule on the 12th trade, the 13th, the 14th. 3 years later, Sarah's $11,000 had grown to just under $31,000. Not explosive. Not a story you'd brag about at a dinner party. But it was real, it was consistent, and unlike Marcus, she still had an account left to compound. Same markets, same volatility, same unpredictable headlines. The difference wasn't intelligence. Sarah probably couldn't build the kind of back-testing model Marcus could build in his sleep. The difference was that she made her position sizing stupidly, boringly small, and that boredom is exactly what let her survive long enough to win. So why does this happen? Why do smart, capable people keep sizing themselves into disaster? There are 5 forces at work here, and once you can name them, you'll start seeing them in your own trade history. The first is what I'll call the conviction trap. Your brain treats confidence as information. When a setup feels obvious, when the chart looks like it's basically shouting at you, your brain interprets that feeling as a signal to bet more. But confidence and correctness are not the same thing. Some of the most confident traders in history have been confidently, catastrophically wrong. The 95% feel the size of their conviction and let it dictate the size of their position. The 5% understand that conviction is a feeling, not a probability, and they refuse to let a feeling override a rule. The second force is the recovery illusion. After a loss, there's a specific kind of mental math that almost every trader does without realizing it. You think, I'm down 8%. If I risk more on the next trade, I can get back to even faster. This feels like strategy. It's actually desperation wearing a suit. The math works exactly backwards. If you're down 50%, you don't need a 50% gain to break even. You need a 100% gain. Because you're now compounding from a smaller base. Sizing up after a loss doesn't fix the hole. It makes the hole deeper and steeper to climb out of. The third force is what I call outcome bias, or more bluntly, survivorship storytelling. You've seen the screenshots. Someone turned $500 into $50,000 in a month by going all in on a single trade. What you don't see are the thousands of accounts that tried the exact same all-in bet and went to zero. The one big winner gets posted. The 1,000 big losers disappear silently. Your brain only has access to the success stories, so it quietly recalibrates what normal risk looks like based on a wildly unrepresentative sample. The fourth force is boredom intolerance. Trading small, disciplined size is, frankly, boring. A 1% risk on a good setup might make you $30 or $40 on a small account. That's not exciting. It doesn't feel like the life-changing move you were promised. So traders size up not because the math tells them to, but because the boredom of proper risk management is emotionally unbearable. They're not solving a financial problem. They're solving a psychological one. And they're using their trading account to do it. The fifth force is the single trade obsession. Most traders think in terms of this trade. Will this one work? The 5% think in terms of this 100 trades. What happens to my account across 100 repetitions of this decision? When you size a single trade like it's the one that matters most, you're implicitly saying you don't trust there to be a next one. When you size every trade as one repetition out of many, the outcome of any single trade stops being able to hurt you. Now here's where it gets mathematical, because this is the part most traders skip. Let's say you have 2 traders with identical strategies, identical win rates, identical risk-reward ratios. The only difference is position size. Trader A risks 2% per trade. Trader B risks 10% per trade. Same edge, same market, same number of trades. A losing streak of 5 trades barely dents Trader A's account. 5 consecutive 2% losses brings the account down by roughly 10%, assuming simple math. And because trades are typically calculated on the remaining balance, It's actually slightly less than that in real compounding terms. Trader A can absorb that, adjust nothing, and keep executing the exact same strategy the next day with a clear head. Trader B, at 10% per trade, takes the same 5-trade losing streak and is down somewhere around 40%, again accounting for the fact that each loss comes off a shrinking base. 40% down requires roughly a 67% gain, just to get back to even. That's not a rough month. That's a multi-year recovery project. Assuming Trader B doesn't panic, doesn't size up further to chase it, and doesn't quit, most do one of those three things. This is the part that should genuinely disturb you if you've been sizing big. The losing streak isn't a rare edge case you need to plan for just in case. Over a large enough sample of trades, a 5-7, even 10-trade losing streak is not a black swan. It's a statistical certainty. It will happen to you, probably more than once, no matter how good your strategy is. The only question is whether your position size lets you survive it standing up, or whether it takes you out at the knees. There's an old idea from professional gamblers and quantitative traders called the risk of ruin. It calculates the probability that a given position size applied consistently eventually wipes out an account, even with a positive edge. And the results are almost always shocking to people seeing them for the first time. A strategy with a genuinely strong edge, a 55 or 60% win rate with good risk-reward, can still have a frighteningly high probability of total ruin if the position size is too aggressive. Meanwhile, cut that same position size down to 1 or 2% per trade, and the risk of ruin drops toward functionally zero. The strategy didn't get better. The survivability did. This is why the 5% don't ask, how much can I make on this trade? They ask, what position size gives my edge the most number of chances to prove itself? Because an edge that never gets a fair number of repetitions isn't really an edge at all. It's a coin flip you happen to size heavily on the wrong day. So let's talk about the shifts. Not vague mindset advice, specific, mechanical changes to how you size. Shift 1, fix your risk percentage before you know anything about the setup. Before you look at the chart, before conviction has a chance to creep in, decide that every trade risks the same fixed percentage of your account, somewhere between 0.5% and 2%, depending on your strategy's volatility. Write it down somewhere you'll see it. The moment you let conviction adjust the number after you've seen the setup, you've reopened the door for the conviction trap to walk back in. Shift 2. Separate the concept of a good setup from the concept of a bigger bet. This is the single most important mental rewiring in this entire video. A setup that looks better doesn't earn a bigger position. It earns the same position, executed with the same discipline. If you want to reward high conviction setups, do it by taking the trade at all, or by giving yourself a slightly wider profit target, not by multiplying the amount of capital you're exposing to being wrong. Shift 3, calculate your risk of ruin for your actual position size using your actual win rate and risk-reward ratio. Do this math once, honestly, even if the number scares you. Most traders have never done this calculation in their entire trading history. They're flying completely blind on the single most important number in their entire strategy. You can find risk of ruin calculators online in about 30 seconds. Run your numbers. If the result unsettles you, that's the math doing its job. Shift 4, plan for the losing streak before it happens, not during it. Decide today, on a calm day, exactly what you'll do after 5 consecutive losses. Will you keep the same size? Will you cut it in half until you get back to a new equity high? Whatever you decide it now, in writing, when you're thinking clearly. The middle of a losing streak is the worst possible moment to be making decisions about how to handle a losing streak, because that's exactly when your brain is most compromised by the recovery illusion. Shift 5, measure your success by process, not by any single trade's outcome. Track how consistently you've followed your position sizing rule over the last 50 trades, not how much any one trade made or lost. A trader who followed the rule perfectly and lost money on a given trade had a better trading day than a trader who broke the rule and got lucky. This will feel wrong to say out loud. It's still true. Outcomes are noisy in the short term. Process is the only thing you actually control. Shift 6. Build boredom into your identity as a trader on purpose. Every time a trade feels exciting, treat that excitement as a warning light, not a green light. Excitement usually means you're sized bigger than your rules allow, or you're about to break a rule to chase a feeling. The 5% have trained themselves to feel a small flicker of relief when a trade is boring, because boring means correctly sized, and correctly sized means survivable. This is where the identity shift happens, and it's bigger than any single rule. Most traders think their job is to find good trades. That's actually the easy part. There are thousands of decent setups in the market every single week. The real job, the job that separates the accounts that compound from the accounts that eventually hit zero, is capital preservation under uncertainty. When you stop seeing yourself as someone hunting for the next big win and start seeing yourself as someone whose primary responsibility is to still have capital left in 6 months, everything downstream changes naturally. Your sizing gets smaller, your patience gets longer, your emotional reaction to any single loss gets quieter, because no single trade was ever big enough to threaten you in the first place. There's a version of you that trades $10,000 positions on a $50,000 account because it feels powerful. And there's a version of you that trades $500 positions on that same account, gets laughed at by the $10,000 version for being too cautious, and is still trading 3 years later, while the aggressive version has already blown 2 accounts and is telling a slightly different story on social media about what happened. Now let's talk about the boring truth, because this is the part nobody wants to hear. If trading feels exciting to you right now, on a regular basis, you are very likely sized too big. Excitement in trading is not a sign that you're doing something right. It's usually a sign that you have too much on the line relative to your account, and your nervous system is responding accordingly. Professional risk managers, the people whose entire job is protecting large pools of capital, describe their best trading days as uneventful, not thrilling. Uneventful. A good trading day for them looks like the rules were followed, the size was correct, and nothing about the emotional experience was memorable. That's the trade-off nobody advertises. Trading big feels like something. It feels like adrenaline, like a movie montage, like the version of trading you saw in a documentary or a forum post. Trading small feels like almost nothing. It feels like checking a box. It feels, frankly, a little bit like doing your taxes. And that emotional flatness is exactly what allows the math of compounding to do its work uninterrupted, trade after trade, month after month, without a single position ever being large enough to blow the whole thing up. Think about it this way. A casino doesn't try to win big on any single hand of blackjack. It doesn't need to. It has a small, consistent statistical edge, and it applies that edge across an enormous number of repetitions, with strict limits on how much any single table can lose in a session. The casino's edge is often just 1 or 2%. But because that edge gets applied over millions of hands with disciplined limits, it turns into one of the most reliable business models on the planet. The casino isn't trying to have an exciting night. It's trying to have the same slightly profitable outcome over and over for as long as the doors stay open. That's not a metaphor for what trading should feel like. That's a direct blueprint. So let's go back to Marcus and Sarah. Marcus, 3 years later, has stopped trading with real money. He still watches the markets, he still has opinions about setups, but after blowing through 2 accounts, he switched to paper trading, mostly out of a mix of caution and something closer to grief, because he genuinely believes, correctly, that his strategy has an edge. What he hasn't rebuilt yet is trust in his own sizing decisions. He knows the math now. He just learned it the expensive way. Sarah, 3 years later, is still driving the same bus route in the mornings. Her trading account, still sized at 1% per trade, has grown past $40,000. Nobody at her job knows she trades. There's no dramatic story to tell, no screenshot worth posting, just a slow, boring compounding line going up and to the right, built on a rule she has never once broken. Not during the 11-trade losing streak, not during the months it felt too slow, not during the trades that felt different and tempted her to size up just this once. Here's the choice in front of you, and it really is this binary. You can keep sizing based on how confident a setup feels, chasing the exciting version of trading that looks good in a screenshot and ends, for almost everyone who plays it long enough, in a blown account. Or you can make the unglamorous decision to size small, size consistently, and let an ordinary edge compound into something extraordinary over enough repetitions to actually matter. The traders who are still trading in 10 years aren't the ones who found the most exciting setups. They're the ones who never let a single trade get big enough to end the story early. Trade small enough to survive being wrong, and you give yourself the one thing every strategy actually needs to work: time.